Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and this week, for the macro debrief, we had a couple of data points come in, mainly revolving around inflation. So starting with obviously CPI, which came in slightly below what was estimated, came in at 2.4% year over year versus the estimated 2.5%. And month over month was lower as well, coming in at 0.1% versus an estimated 0.2%. Core CPI was also below what was estimated as consensus, coming in at 2.8% versus 2.9% year over year, and the month over month numbers were also lower than expected, so 0.1% versus an expected 0.3%. Looking at PPI as well, that came in just about as estimated, so 2.6% versus that which was consensus 2.6%. That was year over year, and month over month was slightly lower at 0.1% versus an expected 0.2%. Core PPI was slightly below what was estimated, coming in at 3% versus 3.1%, and month over month was again 0.1% lower than estimated, which was 0.3%. So obviously the numbers, when you compare it to consensus and what was expected from analysts, look much better, right? But it's important to note that these numbers are slightly higher than previous months. It's just that the increase in inflation has not been as bad as maybe analysts may have expected. And, with this data, I think this kind of reinforces that idea of not needing to rush rate cuts, right? And maybe, inflation comes in slightly late. And I may be personally late on the inflation predictions, but I do think they are coming nonetheless. And I think this slight increase maybe reinforces that, and perhaps we're going to see it in the latter months of the year, as we're just about reaching that halfway point at the moment. Aside from inflation, we had labor market, which comes in pretty much every week. Initial jobless claims were higher than expected, so 248,000 versus an estimated 242,000. Continuing jobless claims were also higher than expected, so 1,956,000 versus an estimated 1,910,000. So again, that slow and steady worsening of the labor market continues, and this time results were somewhat worse than forecasts. So, maybe there's an argument that recession could be coming, but we're not hearing that, I guess, on the street. People aren't really talking about the labor market as much as maybe I think they should, because that genuinely seems to be something that's just steadily worsening. And if inflation comes back and the labor market worsens and, economic growth faces headwinds, then we have ourselves a case of stagflation, which is extremely worrying. But I think aside from some of these macro data points, I think on a much bigger picture, we obviously had the events between Israel and Iran, right, which caused a drop in markets on Friday. The situation is somewhat escalated over the weekend. It's not something, I think we should be seeing in today's day and age, but, we may see markets drop even further early this next week, or, even through the week, right, as tensions may continue to grow. And, I think this puts pressure on investors, right, to allocate capital and think about actually whether it's worth putting money into safe haven assets, right? Are gold or Bitcoin going to be the best performing assets this week? I don't know. It's a possibility. And I think the last bit of macro news, which tragic event, was the Air India flight with relation to the Boeing 787 Dreamliner, right? Heart goes out to all the victims and families of the victims and those affected. Extremely, extremely sad. Now, how did this impact Boeing? Right, the stock was down almost 6% over both Thursday and Friday, right? Inspections are underway for the 787s with regards to safety concerns. And, Boeing has been somewhat of a darling stock under Trump's administration, right? And this is a bit of a hurdle in that comeback story. It's a hurdle in the comeback story of both Boeing and Air India. I do think, however, the pessimism for Boeing may be short-lived, right? I don't think trust in Boeing from a commercial aircraft perspective can get any worse, right? I feel like that trust in Boeing is at an all-time low, or has been at an all-time low over the last couple of years, right? And I think a lot of these faults will be chalked up to previous management under Calhoun. And, maybe if we see further pain here, it could be a slight buying opportunity in this turnaround story. This turnaround story is definitely something I still buy into, I still believe in, especially if defense contracts are on the up, right? With tensions all across the globe, with situations worsening with regards to war, I think, Boeing could see an uptick in those defense contracts. And if that is the case, then the turnaround for this company is still well and truly on, and they're on to be, a company that gains their stride back as the pride of the US, right? The stock is still up about 16.5% year to date, so it's still one that has outperformed the broader market. But I guess now moving on to earnings. I'm not going to talk about too many companies in earnings this week as we're sort of approaching the end of earnings season. But the first one I wanted to talk about was Oracle. Now, Oracle's stock was up about 23% for the week. Solid reports for their fiscal Q4 results, that beat the street's expectations. Their EPS came in higher than expected, came in at $0.70 adjusted versus an expected $1.64. Revenue also came in higher than expected at $15.9 billion versus $15.59 billion, and this was up 11% year over year. So the big theme of their earnings result was that cloud momentum accelerated. Right, so their Q4 total cloud revenue, which includes their software as a service and infrastructure as a service, was up 25%, up to $6.7 billion. Infrastructure as a service revenue was $3 billion, right? That was up 52%, which is solid double-digit growth. And their OCI consumption revenue grew 62%. So their cloud infrastructure revenue for fiscal year 25 was overall up 51% to $10.2 billion, with consumption revenue up 59%. So extremely solid results, right? And their guidance was also raised. So a classic beat and raise. They raised their fiscal year 26 revenue guidance to over $67 billion, which was up 16%. And they expect total cloud revenue to grow over 40% and cloud infrastructure revenue to grow over 70% in constant currency terms. So that's a hugely fast and hugely accelerating growth forecasted by them or guided by them, which obviously markets got very, very excited for. Management highlighted, accelerating demand, an insatiable increase in demand, if I may quote them, for Oracle's AI-enabled database and applications, multi-cloud flexibility, and integrated AI agent-based software as a service suites, right? I think what is expected to be major growth drivers are their strategic SaaS products and database migrations to the cloud. And this will give a continued focus on technical innovation on their end and shareholder returns with this major growth driver. They also spoke a bit about their CapEx for the 2025 fiscal year and for the 2026 fiscal year. So for 2025, it was above $21 billion, compared with less than $7 billion in fiscal 2024, right? And according to CEO Safra Katz, for the new fiscal year 26, it would be above $25 billion. And this is, again, simply due to that excessive demand that they need to satiate. Of course, I guess when we talk about excessive demand in cloud and AI infrastructure, this always means a positive for NVIDIA and their industry-leading chips, and perhaps now I'd even go and say for AMD with regards to their inference chips that they're gunning after so strongly recently, right? When we talk about the cloud space, we've been hearing about AWS, Azure, and Google, right? But Oracle seemed to be a potential dark horse in the cloud space. Now, obviously, I will caveat this by saying the company still has a very small market share in comparison to those big guys, right? So perhaps the growth is ridiculously high because of that, because they're just gaining that small bit of ground and trying to, as best play, catch up with some of these big guys. And of course, this company has done well year to date as a stock. It's been a performer over the last year, but I'm inclined to believe that the valuation is seemingly caught up at the moment. Right, a lot, I think, with regards on a forward-looking basis with regards to stock price. I think a lot depends on the continuation of growth within their cloud segment, as that aggressive growth is priced in. I think negative news, even in the slightest, can send this down to a more modest or digestible valuation going forward. So that is definitely a risk to look out for with regards to Oracle. They're currently trading at a market cap of higher than 600 billion. A pretty high multiple in terms of their valuation, a pretty high PE multiple, but definitely something to keep in mind when looking at this stock, and probably not one I'm particularly interested in at the moment given current valuations, but definitely one to keep on the watch list and look out for given any market activity or slight correction in the price. Now, moving on to the second company that I wanted to talk about this week, and that was Chewy. So for those that aren't aware, Chewy is a pure play e-commerce business that provides pet foods, treats, supplies, medications, and basically other pet products. They're quite well known for their auto ship program, which is their subscription-based recurring deliveries with discounts program, and they also have pet insurance offerings and veterinary services. So essentially, it's a one-stop shop for pet parents to go to. Now, over the last week, this stock was down 12.27%. Right, so let's look at why. Let's look at the results. Their first quarter net sales grew 8.3% year over year to 3.12 billion, which exceeded guidance. And this came with strong active customer growth. It was up 3.8% year over year, and record auto ship customer sales, which made up 82% of net sales, up 14.8% year over year. Their gross margin expanded to 29.6%, which is up 60 basis points year over year on a normalized basis. And this was primarily driven by growth in, sponsored ads, a favorable product mix, and strong auto ship participation. Their adjusted EBITDA came in at 6.2% margin, which was up 50 basis points year over year, and their free cash flow was 48.7 million, with 23.2 million deployed towards share repurchases. So the company remains debt free with 616 million in cash, and they're buying back shares, which is always a good sign, something that always gives investors some level of confidence that management has confidence in the valuation and future prospects of their own business. I think when we look at their Chewy Plus paid membership program, that exited beta, and that is showing strong early adoption with a larger order frequency, higher engagement, and cross-category penetration among members. Right, their auto ship and loyalty programs also continue to drive more wallet share and drive increased retention in customers. Now, their vet care, which is labeled as CVC, Chewy Vet Care, that expanded to 11 different locations with plans for 8 to 10 new clinics in the coming fiscal year. Chewy Vet Care is outperforming expectations with regards to demand generation and customer acquisition. And on top of this, about half of new clinic customers end up making a Chewy.com purchase within 30 days, which shows their ability to cross-sell. Looking at these results, or even talking about these results, it all sounds pretty good, right? Like, I think it begs the question why the stock was down 12%. And I think it comes down to the fact that EPS missed consensus by 11%. Now, when a company this is the same risk I think we see with Oracle or any company that's kind of priced for perfection, or, priced so highly, right? When a company is priced or valued so highly, results that could even look good on paper, just as we saw with Chewy just now, they can still fall short of analyst expectations, and that can lead to a substantial drop in stock price. Like 12% in the last 5 days is not small, right? They maintain guidance despite these strong results. They maintain guidance, and I think the main concern here is that while revenue or their top line may be growing, profitability remains a concern. And for a company that's priced in the way Chewy has been, given a rise in costs because of perhaps tariffs or whatever macroeconomic issue that may arise, it's hard to see drastic margin improvements coming henceforth, right? At least in the short to medium term. And I think when it comes to competitive positioning, of course, I like where Chewy stands. I like how Chewy has differentiated its product. It competes with the likes of Walmart, Amazon, Petco. But when it comes to Chewy, I believe that it's building out a full life cycle of pet care rather than just retail products online or catering to a certain type of pet products like pet food or, pet supplies. They're trying to build that entire full cycle where they want to be, as I said earlier, that go-to one-stop shop for any pet parent, right? And I love that about what Chewy are trying to do with the strategy. But I think the market loves that too, and they've loved it so much that they value the business so highly. So I'd put this company in the bucket of, a great business and company, but a steep valuation, even at current levels. And I think what would get me to change my mind is maybe I would have to see some sustained growth in the top line. Like I think seeing that Chewy can continue to grow that top line aggressively and continue to grow that cross-selling strategy that they've shown with Chewy Vet Care, as well as seeing some more growth in the bottom line, I would then start to feel comfortable about owning this stock and seeing where it is going. Now, I think the last topic of today wanted to slightly deviate from earnings, but it's from early on in this week, and it was Apple's big event, right? The Apple WWDC. Now, if I have to sum that up in one word, I'd probably say it was a disappointment. I mean, liquid glass, really? If that was honestly the big takeaway, if that's going to be the main thing that people are talking about, it just feels like a bit of a gimmick to me. I get it. The interface and aesthetic is going to help blend in the Vision Pro as a product into the entire ecosystem, right? Because the way you view things in, augmented reality or virtual reality can sort of be compared to a liquid glass. But the fact that there has been no update with AI, with Siri, or anything that surrounds, hardcore tech innovation in modern day is just extremely disappointing. One of the updates was around live call translation, which is great for people who want to communicate across languages and cultures, and those that have had an iPhone have not had this. But this isn't new or groundbreaking technology. Samsung and Google have had this on their phones for a while, and Apple is just playing catch up here. With regards to Apple, I feel like they seem to have just gotten lazy as a company. They have an incredibly loyal fan base, a very sticky fan base. And their ecosystem is just so hard to break out of. As someone who, has had a vast amount of Apple products during his life, I think it is definitely a sticky ecosystem, and the product is very sticky because switching costs, not non-monetary switching costs, are high. But even for someone like me, I think price increases for products that just basically show a lack of innovation. Apple are likely to lose me as a user. I've already switched out of my Apple Watch to a Garmin, which I've been enjoying much, much more. And I've gotten rid of my AirPods for other earbuds. And, my phone is likely to follow suit. And, overall, sadly, it was just underwhelming and disappointing as an event. And, not to speculate, but hopefully it won't be... Hopefully I won't be saying the same for the Tesla Cybercab robotaxi launch that is coming up later this month. So I think that's one to wait and watch in the near future. But that does it for this week. A reminder that none of this is formal investment advice. It's all simply for educational and informational purposes. These are opinions of mine. I thank you for listening. With that, I'm Anurag Birla, and this is the Finance Now Podcast.